welcome you all to the financial store that we have curated for you all over the next few days. We, are glad to cover. We were glad to cover a variety of topics over the next few days, ranging from the payment solutions, credit cards, to BNPL, to fintech, to the traditional profit pools in the industry. And in the morning, to start our first session, we have the privilege of hosting HDFC Bank, and from HDFC Bank we have Parag Rao, who's the country head for the payments, consumer finance, and digital banking. He's joined by Srinivasan Vaidyanathan, who's the CFO. Both Parag and Srini are very well known to pretty much all of you, so I would not get into the introductory part. I would just quickly read out the disclaimer. This call is strictly for the clients of Goldman Sachs only. This conversation is not intended for the media and is off the record. A participant will be removed from the call if they cannot be properly identified. And this call webcast is not for the purpose of sharing or receiving any non-public information. And attendees are public side market participants who may not receive and should not request any non-public or otherwise confidential information. With that out of the way, thank you so much, Parag and Srini, for your time this morning. Really glad to have you. Of course, there's a big focus on what's happening on the payment side. Of course, the regulators have also intended to come out with certain regulations. There are fintechs who are entering into this field with a lot of money on the backside. And you have been a pretty successful large player, making fair bit of running a fair bit of tight ship with profitability being a key focus for you all. With that, would love to hear from you, Parag. After the ban got lifted last year in August, perhaps how has been the journey? We saw you all arrested the market share loss. It stabilized. How do you see that playing out now? What are the in absence, and or rather with COVID coming back again and again, what are the 3 or 4 large areas which is driving the spends? What are your views on the payment ecosystem overall? And finally, the regulatory bit. So with that, would love to start the conversation from you. Just to remind the participants, this is a fireside chat, but if you have any question, please raise your hand, or you can alternatively email me at rahul.m.jain@gs.com, and we'll be happy to ask your questions. So with that, Parag, over to you. Parag, you're on mute. Sorry.
Thank you, Rahul. Thank you for this opportunity to sort of meet and address everyone, even though it's virtual. Good afternoon to all of you. It's a privilege to really talk to you and share our thoughts and ideas. Rahul, I'll take all your questions, but maybe not necessarily in the same order that you sort of read them out. I'll just start off with a sort of slight preamble to say that the way the bank sees payments overall, okay, and I'm sure this is the way the economy sees it, and various other regulators, etc. see it. Well, payments seems to have emerged, especially after demonetization and definitely during the COVID period, is that payments is now even more so deeply embedded in overall commerce, if you call so, or if I were to take it even further, it's about the movement of money from point A to point B, and then you can add various labels. Is it money transfers? Is it a payment? Is it a receipt? You spend on something, receipt money, whatever you call it, it's about movement of money from point A to point B. And in that sense, payments and the network which is being built by banks like us, or large networks, etc., is going to be the lifeline, and we reckon a significant driver of a lot of the future India growth. I mean, at least over the next 2 to 3 years, because it's about movement of money, aside of other things like infrastructure investments, etc., and opening up of the markets. And we've seen huge amount of activity especially over the last 3 to 4 years, where large number of players have come in. The dimension and the complexion or the texture of competition has completely changed. We as a bank used to erstwhile say traditionally call many of the other banks as competition, but now that definition is completely morphed and sort of and you've got many other players of different natures and different types coming into the payment business exactly for this reason. And that's also the reason why we as a bank very clearly remain invested in this space, deeply invested in this space, and will continue investing in payments overall, which means payments, investments in the network infrastructure, expanding the network, payments in enabling both sides of the movement of money, the point A to point B, because they are our customers also for our large retail bank, payments, investments in instruments which enable these payment flows. You call them issuing instruments, you call them the network or the acceptance business, and these are the labels we sort of know of. Okay, and it's an extremely important business for the bank also, not just because of where some parts of the business are obviously profitable, but for two key strategic reasons. One is payments therefore becomes a good entry point into relationships, larger financial relationships, either of entities, institutions, individuals like you and me, small businesses, etc. Okay, and from a coming down to closer consumer behavior, payments is also very deeply engaging product category. Okay, in the sense that as compared to many other financial service products, which are annuity or one-time products, etc., payments is about that you can interact with your service provider 5 times a day, 10 times a day, every day, do all sorts of kind of transactions, and therefore it's a very, if you may call so, engaging product. And that's where the concept of our portfolio management comes in, which I'll talk to you sometime during the day. So like I said, it's an important business for us, very critical, and as a large bank, we are invested in the growth of the economy also, and being a large part of the economy, we'll continue investing in the payment business. Having said this, coming down to some of the specific topics, yes, after the embargo got lifted, like I said, we had clearly said, and I had clearly said that we'd be back with the bank. And back with the bank means sort of getting back to a particular run rate and then building on from there. So I think we've done that in terms of the kind of run rate. The immediate, obviously, objective was to stem the market share loss, which arose out of the thing. But having reached there, I think the next step is now to grow slowly. Mind you, it is very tempting for many people to ask to say, hey, why can't you sort of issue more cards and etc., start gallivanting, and rapidly increasing the market share. There we said no. We've said no. We've always run the credit card business in a prudent manner, in that we would like to pick and choose our customers because we're interested in building a strong portfolio. We're not really taken in by this thing of saying, I want to show you huge headline numbers. No, that's a very short-term strategy. We want to build portfolio, and hence we will balance off scale, then the need for scale, along with picking the right credit and also doing deep engagement on the portfolio, because what we're ultimately interested in picking the right kind of customer, okay, giving him the right kind of value, ensuring that he's deeply engaged with us, and thereby you build a strong, sustainable, growing portfolio. Probably one of the reasons why we are also here in this kind of a call, to figure out how do you run a good, successful card business. Okay, so we've reached a particular run rate and we continue sort of growing. We had also stated the intention of tying up with a large number of partners, which will complement our acquisition strategy. Okay, we've announced one. There are a couple of more sort of in the pipeline. I'm sorry, I may not be able to talk about them. But talking about these two parts, so organic growth, just to sort of give you this, we are a 60 million plus customer bank franchise. My card base is only 15 million. So to the extent that you can clearly see the headroom for growth, even within my own bank's portfolio, I think, or bank customer base, I think lies significantly large. So our growth will come at scale, but we are very clear we're not going to dilute our credit policy norms. It keeps on being calibrated depending on the market conditions, and we'll always continue that approach. So we have significant amount of headroom to grow even in my own bank customer base, and you'll continue seeing that a dominant part of our business will also still come from existing bank customers. Okay, that being said, we also realize and understand that there are very strong brand franchise or pockets of excellence arriving in different customer segments. Okay, and then therein comes our strategic partner and alliance strategy, wherein we will partner with like-minded players, wherein both partners can bring in good value, and with two objectives, like I said, incrementally sort of look at a lot of the new to bank customers, and second is obviously look at increasing our presence and market share in segments where we erstwhile may not have been there, or we may not be as weak, or we may want to sort of partner with guys and jointly go together. So that part of the strategy. So we have robust growth plans. Like I said, I mean, if it comes to numbers, maybe Ajit can sort of share some of them, but I think we continue grow, and therefore our growth rate and an increase in market share will be a calibrated market share. We've gone through 2 years of a lot of uncertainty, especially on the credit front. But I think we've learned a lot in that space. We do expect good amount of growth coming in now post the pandemic, and we've got our plans sort of in place. You asked a question about regulation. I think just as much as, like I said, the last 2 years have been learnings for us as a bank. I think the entire ecosystem, and including the regulators, also observed and learned, etc. A lot of it. One key development, which I'm sure you must have all read about, is the formation of the tech department in RBI. Okay, which as we understand, the objective is to see how the banking space, in the way it was always been, and the new emerging fintech space, I think how opportunities can be leveraged by both the ecosystems, how you can sort of set in larger guidance, governance rules, etc. I think, and I think, without it being so explicitly said, it's a great opportunity, and I think this department will really drive it, for both the ecosystems to come together, bring their strengths to the table, and jointly sort of open up the market. Because ultimately, I think the objective, not just of RBI but also of the government, is to expand payment space, electronification, bring in a lot of efficiency in money movement, transparency in money movement. And I think the payment business is at the forefront of this objective. Okay, so I think it makes a lot of sense for partnerships to keep on happening, wherein you can exchange. On one side, you have people who are responsible for managing the money and wealth of individuals, etc. On this side, you have an ecosystem which is nimble, agile, has a different way of looking at business issues and business problems, using technology to solve problems. And I think it'd be a good alliance of both. So I think that's one major, I think, initiative, and I'm sure that over the next ensuing quarters, we'll see a lot of announcements and developments which will happen, which will only encourage, I think, participants to sort of move on in this space. In terms of overall larger growth, I think whilst the payment industry has been growing significantly, and within that you'll see different form factors growing at different rates, UPI being probably the front runner in terms of growth rates, even though they're coming from a smaller sort of denominator, and the other form factors also growing at very different rates. I think the payment industry overall seems to be growing at a good clip. Okay, thereby sort of giving opportunities for growth for everyone. And so we see that as a very positive trend for sort of growth. Two, three new trends which we see happening, obviously, over the last 2 to 3 years, because of the pandemic. You've seen a huge number of new customers, new to category customers coming in, people who are mobile savvy friendly, who are now used to making electronic payments and actually eschewing cash. And so therefore, these customers are ripe for sort of getting onboarded into formal, more sophisticated type of payment products. Okay, and in that sense, that ecosystem and opportunity for the sort of growth is obviously there. This is on the issuing side at a high level. On the acceptance side, you also see commerce going much more deeper down on one trajectory in terms of geographical expansion, more and more merchants starting to accept electronic payments, and once again sort of eating into that whole huge cash pile. Okay, and so there's a large opportunity for acquiring physical merchants. On the e-com side, obviously, we've seen a huge shift of of customer demand and movement of goods and money to e-com or online, as you all call, again, driven by what happened in the ecosystem. And so therefore, you've seen a good, robust growth also happening on in-app or online sort of categories. Once again, there's significant headroom for growth in those spaces. Okay, and each one of these are, like I said, very important focus areas for us as the bank. We have our sort of strategies and plans laid out. So we see net, I think we see a significant amount of growth opportunity. We have a great amount of experience in running good profitable portfolios. We've got a deep focus on customer engagement, portfolio management, if you may call so. We've got a very strong credit net having been created over the last 20 years, and therefore a strong ability to sort of underwrite and pick and choose good customers for the future. We have very large and very deeply embedded channels which help us address multiple customer segments, whether it's online or offline, whether it's the government or whether it's the retail small trader or whether it's small consumer in a small town in deep geography, Suru, as you may call it. Okay, and we will keep on sort of digitizing all of those things and expand our sort of this thing. So net in a nutshell, sort of, I think we see a good positive momentum already in our business, and we'll continue adding on to our strategies to grow. We see a lot of headroom to grow without necessarily compromising or diluting on our credit standards. And we've got a good thing to go. I've said, and I'll pause here. Srini, you may want to add if you want to add on something, and then
only 1 or 2 sentences. You covered all of it, but Rahul, to think about it was also about how a bank is positioned, right, and how our bank is positioned for the opportunity in the market, right. So if you think about it, first is you need a product continuum, right. That means credit card perhaps not the first product for somebody. Is one of the products in the customer journey, right? So there should be a product that you have. Perhaps somebody starts with an unsecured, goes to a revolving, goes to a mortgage, gets to an auto, and so on and so forth. So you need a product continuum, which the bank is well positioned and with the tested scorecards and the credit modeling over a longer period of time. That's one product. The next thing is the customer continuum. So that means what you mean by that is a bankable customer. That's what I mean. But there will be some customers who are entering into the banking system, and as they enter into the banking system, then there is a journey that they take from the beginning of their journey, from a savings account and so on to building up various of their wealth profile along the way. So there is a customer continuum, and is there a product that suits that customer continuum? And then to stitch this product and customer, is there an ecosystem banking, which Parag talked about? Then you stitch that merchant ecosystem together to get that acceptance and bring broad-based that relationship. Then you also stitch the corporate relationship for the corporate salary customers. You have the rural relationship, you have the supply chain relationship, and so thereby you multiply that product and customer continuum into across these ecosystems to bring it together. And that's what our bank is for, and that's how you should view and think about how are we executing against that.
Got it. Thanks, Parag. Thanks, Srini. A couple of questions from what you just talked about. Going back to the engagement point, Parag, clearly, I think, the debate between banks and the fintechs on the UPI platform or the digital, retail payment platform, engagement clearly seems to have shifted big time on the platforms, that is run by the big techs and the fintechs. This bank is actually, doing the, settlement in the background. Do you see a trend where the customer stickiness or the engagement or the ownership is gradually shifting away from the banks, i.e., it could also mean that the inertia which always used to exist in the banking customer base is dropping, and therefore the customer might have a higher risk of flight to the other players, and therefore higher would be the need for spending more money, coming out with more innovative products, which may also mean that lower interest income or lower fee, etc. So how's that ecosystem changing because of the engagement shifting away from the banks particularly?
Okay, thanks, Rahul. That's a good question. I mean, this quick question keeps on getting asked at multiple forums and debated. Okay, but let me start by saying we're a bank. our core competency is 2-3 core areas. I mean, we're in the business of what we call liabilities, which means keeping the wealth of money of customers safe. By customers, I mean everyone from institutions to individual customers, merchants, whatever you call it. Okay, we're in the business of payments, which is facilitating movement of money from point A to point B. And we're in the business of obviously lending, okay, which means using all of this data and using all of the money which sort of people you sort of underwrite people and do that. This is a core business. Okay, traditionally people would come to banks to do a lot of their products and services. Obviously, over the last 3, 4, 5 years, you're seeing many more avenues in which people are sort of accessing financial products. So whether it's e-com sites, whether it is an app which is helping you book a taxi, etc., etc. Those are businesses we're not in, but those are the partners whom we'll partner with, because ultimately it's a customer consuming a particular service there on a platform, but still ultimately coming to me for a payment, or still coming to access his bank account because he needs to make a payment through UPI or NEFT or what have you call. Okay, or he needs to buy something. Does he need something on an EMI, or can he take a loan? He still needs to come to me. Now, what's changed obviously is the route, or the route in which the customer is now coming to the bank. Earlier, it would have to come directly or to a net banking site or call center. Now he comes through multiple of these platforms, etc., etc. In that context, so therefore, the way we see it is, and you raised this question about people moving from traditional lanes to UPI, etc. We are agnostic to that. We're a bank. We offer all those products. So we not only offer credit cards, we also offer NEFT, RTGS, we also offer UPI. And if there are newer payment forms which come in, those will continue. Srini talked about our product continuum, etc. That's part of our product continuum, because that's my role. And I will continue offering and being a full suite payment service provider by offering all sorts of instruments or all sorts of acceptance forms, which a customer, could be an individual like you and me or a merchant, will always desire. And in that sense, I am a payment in a box, just to give you an example, or I could be a lender in a box, or a bank in a box, because it's my job to offer the full suite of products which a customer will require. Now, how do I therefore access the multiple ways in which now customers do? That's where I now either partner with these things, and the best example of our partnerships is exactly a merchant acceptance business. If I deal with 2.6 million merchants, these 2.6 million merchants generate 45 to 50% of the commerce which happens in India, and that's by the way our market share in the acceptance business. Okay, it means the bulk of consumers go to those merchants, they transact there, and all those payments or receipts, whatever, come through my network. Okay, and so that, in a sense, that's a very large. So my merchant acceptance business, besides being other things, is also a very large alliance or a network, partner network, which you've sort of created. Okay, and my job, therefore, as a bank, will be to continue forging these partnerships or relationships. Okay, things like co-brands, etc., are more advanced ways of partnerships, etc. But fundamentally, it's about that. Okay, so my merchant acceptance business actually becomes a front runner or driver of a lot of these relationships by me creating that network of merchant alliances, partnerships, which will help sort of, like I said, to the merchant side, give him a one-box solution so that he can offer everything starting from traditional POS machine or a PG or a QR or a tap and pay or through the mobile, what have you, etc. And take care of the merchant's needs through a liability, full suite liability offering, and lending to him or lending through his customers to him. Okay, we're in the process of actually rolling out our banking as a service initiative. Okay, we'll start off slowly and build up, wherein I can now, through API technology, expose a lot of my products through a POS machine or an app at the merchant side, so that the merchant's customers can also access a lot of banking products to that. Now, I have that network. Which I can do. I have not just the network and acceptance, please do mind you. I have a much deeper relationship with that merchant, because I not just own his payment, I also own his liability and his family accounts, and where his business accounts, I also lend to him. So I own the relationship in that whole thing, and that ecosystem is actually profitable for me from day one. Okay, I don't just hold one piece of it saying that I have a QR. No, I hold the whole piece. And that gives me a significant kind of arbitrage and leverage with this thing to expand my network and access a lot of customers to you. If you recall, and slight deviation, we created a platform called Festive Treats. What is that Festive Treat? That's a platform approach to actually bringing this arbitrage together in the way consumers love it. I take my merchant acceptance footprint on one side, I take my very large issuing base on the other side, bring them together on this platform called Festive Treats. And I'm sure each one of you on this call have actually experienced in some form or the other over the last 3 years the beauty of Festive Treats, wherein I bring those offers and customers together. Customers great offers if they use HDFC Bank instruments at merchants. Merchants see increased footfall and flow, and it becomes a great, because business increases for everyone. I think everyone seems to be happy. Okay, and that's the power of, Srini again mentioned it, the power of a platform approach which we sort of created, and that. And therefore, our strategy to the marketplace, whether it's the acquiring business or the issuing business, will be a platform approach, a one-box approach. Come to me as a single service provider. I'll give you everything. I'll connect you to multiple ecosystems and keep on showing you value. And in that value, like I said, if I may call it so, I call it in a very simplistic form my sandwich strategy. Okay, I enter into many relationships through payments. Okay, I buttress it at the bottom with a liability relationship, and I overlay on top of it with a asset or a lending relationship. That becomes my sandwich, and then you can add the dressing and the sauces, etc. on that, which is, today you can call it the digital. Okay, that constant having a wonderful UI, UX, etc. There, let me sort of take the bull by the horns. You can question me to say, hey, are you up there, etc. I think no, that's a area where we're investing again in terms of digitization, improving our UI, UX, etc., etc. It's a journey. We've started on our journey. Okay, but we have the fundamental building blocks in place. We're building that whole huge digital and digitization layer in partnerships and doing a lot on our own. And our aim is to actually therefore continue dominating that space. Okay, so I hope I've answered your question in slightly a different way, but fundamentally that's our approach to the market.
No, I get it, and I've got many more questions.
By the way, I stick to my knitting, and where I can't do that business, I partner.
Sure. Yeah, no, we did experience your. Sorry.
Another context, right? In some other context, we talked about it too, which is the way you think about it is three distinct activities in a bank, right? As opposed to a monoline or wherever, right? As opposed to anybody else in a bank, you acquire customers. You have various channels to acquire. Then you deliver products and services, and you have relationship management. These are three distinct activities that you do. The profit pool is in relationship management. That is what Parag talked about, many things in terms of the sandwich strategy and making things available, everything, right? And then the ecosystem and the platform, all of that comes in, right? Relationship management. And he also talked about partnerships, right? And partnerships are to get that customer wherever the person is. If it is not in our direct channels, in any other channels, bring the customer in, right? So acquire. And you measure the success of that to bringing the optimum quality and quantity of customers at the right kind of cost of acquisition. That's where you bring them, right? That's how you measure that. Because that's a cost. These are all cost centers we're talking about, right? Then you deliver the products and services. They are also cost centers. And you can have a mobile banking, you can have a net banking, you can have various other mechanisms to deliver them, right? Deliver directly, deliver through partners, deliver digitally, anything you can do. That's cost. It's a cost center, how you optimize it and deliver it, right? And then comes the relationship, which is what the broad base, all of that conversation Parag gave us about how do you keep that relationship kicking and going. So you deepen. So it is not about a single product. It is about a complete relationship. So it is not about product profitability. It is about customer relationship value.
Got it. No, that's very helpful and comprehensive. I have more questions, but I see Madhu from Ishana has a question. So Madhu, please unmute your line.
Yeah. Hi, Parag. Hi, Srini. Thanks for offering your perspectives as always. I have three questions. The first one is around cards again. I think you rightly articulated that the demand drivers are in place. But I want your thoughts on merchant acceptance. Do you think that lowering MDR or within that the interchange given that there's a floor on how much you can lower it. Do you think that will actually expand the market and create elasticity in terms of merchant acceptance?
Okay, so there are two contradicting sort of evidences available in the marketplace on this theory of dropping MDR with increased volumes. On one side, we've seen there was an intervention a couple of years back on debit, okay, where the interchange was sort of capped. Okay, we did see some growth, but not as much as probably the ecosystem expected. Okay, that's one learning. Okay, the other learning we saw is that, and I'll talk to you about my view on that. The other learning we've seen is UPI, probably from day one was anyway zero MDR sort of ecosystem, and there we've seen significant volume sort of growing. So you can choose to debate this contradictory results, but it's there for us to see. My view on this is very clearly, I think it's actually less about MDR and more about the convenience. Okay, so UPI, if you see, extremely convenient form factor. I think a wonderful job done by NPCI in creating a form factor which is very simple yet safe, and clearly because of its simplicity and ease of use, I think it's targeted, whether you call it by default or by design, at the right kind of segment, which is cash. And I think that's what I think it's doing its job very well in terms of displacing cash. It's a very simple way in terms of payment. You've seen huge amount of adoption. In fact, a significant number of customers who have adopted UPI, people who first time sort of got onto the formal electronic or sort of payment sort of bandwagon. I think so. My view is, I think convenience, easy access, easy acceptance, or ubiquitous acceptance, I think, are factors and which have really helped the significantly high growth of UPI. Having said this, our views are also very clear that there needs to be some money or revenue, if you may call so, generated in the ecosystem, because please do understand, the payment business dynamic as it is, as you know, constantly requires investments in expansion of the network, investments in upgradation of the technology, investments in network security, and investments in security of customer transactions, so on and so forth. Okay, and so therefore there needs to be a viable revenue model available. Up till now, if you see, most of the investments or the bulk of the investments have been done by the banking investment industry and the networks. Okay, and so I think the view is that there needs to be, I think, a fair business model wherein you can use some of that revenue to plow back into these investments. We are very clear that I said it at the beginning of this thing, that we believe that the payment network will be a driver of a large portion of the domestic consumption, India being a large domestic consumption marketplace, but it requires significant more investments and continued investments in all the vectors which I talked about. Okay, and so there needs to be a viable business model, and I think that's the debate which we're having with everyone. I hope that answers your question.
Got it. Very clear. And the second question is around churn rates, both on the customer side within the cards portfolio and on the merchant acquiring side with regards to POS machines. Directionally, would you say with competition increasing over the last 2-3 years, churn rates have gone up, or is there nothing to call out?
When you say churn rates, you mean you mean people shifting from one card to another? Is that what you mean by churn rates?
Yes. One card issuer to another. So at a cohort level. So I'm not talking about activation rates, given that the MAT gets built up with new acquisition, but just at a cohort level, would you say in general the industry churn is up across both customers and merchants?
The way I see it, and I've seen the card business over the last 20 years, okay, and this and some of these behaviors, I also see consistent behaviors, rather consumer behaviors, I see across geographies, even in developed economies. Okay, is that ultimately you'll always have promiscuity and promiscuous customers, because you'll always have at any point of time an offer which is better than yours. Okay, and there's always a set of customers who would sort of keep on shifting loyalties just because of a particular offer. These are tactical interventions, will keep on happening, and that's the nature of competition. Okay, there'll also always be some new player coming in, some new player sort of going out, etc., etc. All of these are part and parcel of what doing our business as usual. But our learning has been that consistent good customer service, consistently offering a full suite of products, not necessarily the most discounted or the best discount offered products. I think customers, value that in the long run. Consistency of service, great products. Not 1 year you're doing great and 1 year you sort of withdraw everything. I think that's what they also, of course, value good strong brands in their thing. And typically, as we all as consumers are, we know that it's a pain to handle multiple financial instruments from multiple financial entities. It's a pain, whether it's reconciliation, whether it's all of that, just keeping track of your expenses, etc. So you'll get a promiscuous set, and you'll always, even you and me, fish out and find out what's the best rate, etc. But ultimately, I think serious consumers will ultimately gravitate to their top 1 or 2 service providers in the financial space. I think that's a phenomenon we see globally happening. We see in India also happening. And there'll always be that moving population will say, okay, fine, I use your card, but yeah, for this particular thing, iska offer jada acha, I'll use it for now. So maybe a transaction may go here and there, etc. This phenomenon will continue happening. Our focus is on the medium to long term, and which is why I talked about strong portfolio management, engagement management. It's to consistently keep on showing customers the value which they have by sort of engaging with HDFC Bank across its whole suite of products and value, and not just necessarily talking about what's the best cashback or what's the best reward point offer. We also do those things. Having said this, we also do those things, and we probably have the largest number of partnerships and tie-ups, especially when you see the festive treats and festive season also. We also do that, but that's not our main strategy. Our main strategy is actually core basic, simple relationship management, good products, simple products, value, etc., etc. That continues to be the case. Mind you, one last sort of caveat on this: having the best offer and having the most lucrative features are not good for making money. Okay, you never make money on such kind of products. Okay, so I think business is about optimizing all resources, and so our approach is always medium term to long term in this area. I hope that answers your question.
So just to clarify, I guess my takeaway is that 2 things. One is churn rates are business as usual. There's nothing to particularly call out. And secondly, you're saying if you can engage the customer across multiple touch points, then qualitatively your churn rates will be much lower versus the rest of the industry. Is that the right takeaway to read? Okay,
absolutely.
Got it. And my third quick question, unrelated to payments, I think more for Srini, which is in the current inflationary environment where demand for working capital for corporates seems to be quite strong. If you could talk a little bit about how we're being nimble and gaining market share at the expense of PSU banks. We see that anecdotally and in the data. So just curious to hear what you're doing right and what sort of an opportunities that you're seeing.
Okay, yeah. See this. If you think about the working capital, it goes across all the three segments for us. One is the wholesale banking, and the second one is the commercial and rural, and the third one is retail. Right, across all of this, there is some level of working capital. The highest being, of course, in the wholesale segment, right, and then in the commercial and rural segment. That's where the bulk of the working capital is. Now, in terms of our share, if you see, on the corporate side, which is not new. So a few years ago, we started this in terms of getting the host-to-host integration done so that digitally the customer, the client, in this case, the corporate customer, can dial up and dial down in a seamless manner in terms of whatever credit they need, which means they don't need to be calling or having a relationship conversation or a credit kind of a conversation to do that, because everything is set up digitally for them to use when they want, right? So it is seamless use. That was what part of what you see, the huge drawdowns that happened at the beginning of the COVID cycle was exactly because things are available and all they need to do is go and utilize it digitally, nothing to be done physically. So that is one that we did on that front. On the commercial and rural, in terms of gaining more market share on the working capital side, is both the people strategy, which is a relationship management strategy, as well as the branch distribution strategy, which is we were offering this commercial and rural, call it in about 450 or 500 districts or so. Now we are taking that up to 600 districts, right? Out of the 650 districts or so in the country, we want to be offering this across all. Again, the reason for that is the supply chain management, which is again part of the working capital deepening, is not only capture the corporate relationship, but also on the supply chain where the money is flowing into the commercial segment, and then within the commercial segment, into the commercial segment supply chain. And if we need to be participating wherever, follow the money concept to get this working capital, we need to be across most of the geographies, which is part of what we are trying to expand, which is geographic expansion. And RM expansion is nothing but bringing that experience of that corporate relationship into this commercial segment to say that we have the similar engagement model of our RMs with our commercial and rural customers or their business model in terms of assessing and giving the right kind of a credit to be always engaged from a credit point of view. So ears in the ground, call it like that, right? Whatever you think about it, so that we are able to get to maximize that aspect of it. That's how we are operating to expand the market share.
Got it. So is it fair to say that I guess in the last couple of years, and it's been in the works for a long time, but with this strategy, you've finally managed to sort of break the formula of PSU banks in terms of the physical touch and having to call up a relationship manager for working capital. So is this an inflection point? And like most of the inflection points in the past, should we expect significant market share shifts?
We believe so, that we have passed that inflection point in terms of the COVID had put a speed breaker, right, for a couple of years, but we believe we are more or less past that hump on that, and things are kicking and going, and it is also a function of the economy. So it's not just that we can operate in isolation. Now the economy is also kicking and going quite fast, and we are there capturing the kind of enablement that we have done to participate in this. Yes.
Got it. Thank you so much.
Thanks, Madhu. Thanks, Srini. Thanks, Parag. I've got a few questions on my email, but I see Mayuri raise her hand, so would unmute her line. Mayuri, please go ahead.
Thank you. Hi, Srini. Hi, Parag. Thank you for spending some time with us and sharing your perspective. Question is, what do you think of the B2B payments for the SME segment? Do you think that's a vast opportunity? And how are you specifically targeting to monetize that?
Okay.
Sorry, Parag, just to add to that, if you can also, when you talk about how you are targeting that, if you can also please demarcate between what you're doing in-house versus partnerships.
Okay. So B2B actually is what we call in the issuing side, especially the credit side, credit and debit side, is what we call the commercial card business. Okay, there's a consumer business, and there's a consumers are you and me, and corporate card or the commercial card business, of which corporate cards, business cards, purchase cards is sort of, these are the kind of products which you have, is another line of business which we have been running for a couple of years right now. Okay, which targets these B2B kind of spends. Coming specifically to business cards, we've got a very strong and large, very robust growth strategy in the business card space. Business cards are typically targeted at SME, MSME, merchants, if you call so, for enabling their business expenses on the card or utility bills on the card, all business related stuff. Okay. Our starting point itself is our entire very large merchant base. Our starting point is a very large SME base, which is catered to by our, within the bank, we have what we call the BBG or the SME or the segments or the EEG segments, which deal with many of these MSMEs or SMEs, etc., etc. Okay, they have large business cardable expenses, a lot of business expenses which can be put on the card. And so we've got a very strong outreach to all of these segments through the RMs, which manage them as, say, an ECG customer or a BBG customer, or the merchant acquiring teams which manage the merchant relationship, but at the same time, sort of cross-sell a business card to that base. So that's one large growth area. And like I said, as our merchant acceptance business and as our SME business and BBG business continues growing in terms of number of customers, part of the program or part of the approach as a banking is a business card, which sort of helps him card a lot of his business expenses and put them on a card. Okay. This segment is because they're B2B spends, you actually see very good engagement rates, attachment rates on a business card given to it. When you compare it with a typical consumer card, sort of the spends are a multiple X of what a typical consumer like you and me would sort of put onto a card. Okay, it's a great segment to sort of be in. It also electronifies a lot of his expenses and gives you a good segue into that segment. So that's a very large segment and focus area for us right now. Like I said, it's part of our larger commercial card business, and commercial cards, SMA or business SMEs, etc. is one segment. The other segment are the large Cat A, B corporates whom we sort of deal with.
Correct.
There you have different variants like a corporate T&E card. We all, if you're in an employee of a large corporate, you get a card for expenses, or there are things like purchase cards, utility cards, etc. A lot of, again, cards given for specific purposes where you sort of electronify or put a lot of your regular expenses, maybe C category items or things which use a lot of administrative departments to sort of cut checks or sort of do NEFTs and put them on a card. And with the benefits of having a one view reconciliation, getting a lot of secondary, tertiary data, etc., all of that. So that's
exactly. Actually, it's quite interesting that you spoke about cards as the as your primary, or I mean the instinctive thought when
cards is not just cards is, by the way, cards is not just credit card. Let me tell you, for example, in the business segment, we have a business debit card also in our portfolio. And once again, in the business debit card portfolio, for some of the merchants whom you may not be able to underwrite or may not want to underwrite right now, the business debit card usage again is very encouraging and maybe in multiples of X as opposed to a regular debit card. So the merchants see a lot of value. Even debit.
This is helpful. You talked about the perspective that you took for this specific question was more, you have asset level relationships. How I was thinking is, because you already have such a vast base of asset side relationships in this segment, would you also be thinking about extending that to services? For example, what about your payment gateway services or your AR AP or checkout services, because that would probably make you a whole suite of cover the entire suite of offerings for an SMB, and possibly also make the relationship much beyond monetizable relationship, much beyond cards. So absolutely. That was the perspective I thought.
You're right. So let me talk about our Smart Hub Vyapar offering, which we've created. We've gone to the market in a software because we're in what we call evolution. We're in MVP 1 or stage 1. We're soon rolling out MVP 2, which is okay. But fundamentally, what is the concept of a Smart Hub Vyapar? We are now saying, okay, that I will go to a merchant, and typically these are the very small merchants, the people who don't take a POS. Okay, let's say that, and also people who take a POS. I'm going to him with saying, I'm giving you a platform in an app. It's a Smart Hub Vyapar app called it's a bank in a box. What do I mean by bank in a box? It has 3-4 modules. Okay, all in the app. It's all payments in a box, which means it enables the merchant to accept any form factor which his customer wants to pay him by. Okay, ranging from starting from the QR, the UPI, the SMS-based links to do remote payments, enabling him onto a payment gateway. That's all payment in a box. That's one. It gives him banking in a box. Okay, so he can open his accounts online. He can transact online. He can open an FD online. That's and the whole gamut of banking services. It gives him assets in a box. So inside the app, he gets his eligibilities to say, because you're a merchant with us, because you have a current account with us, you're eligible for ABC, XYZ loan, tap here, click here, etc., etc. All of this is WIP, but I'm saying we've already launched that. Okay, and then there is another module we call value-added services, which are not necessarily banking or financial services, but these are value-added services which the merchant uses as an adjunct to his larger financial thing, but help him increase his business. Example, can I give him the capability inside the app to take a photograph of his product and then send that photograph through WhatsApp or through his Facebook to say 20 of his customers, attached with a payment link so that you can buy it online and click on the link and make a payment. give him a loyalty, give him a account reconciliation package, etc., etc., etc. So this is the Smarta Vyapar concept, which we've already rolled out. We have approximately 2.5 to 3 lakh merchants, existing merchants of the bank, already upgraded to the Smarta Vyapar platform. These are a combination of people who only had a QR first, or only had we had an older version of the app, etc. Okay, or POS merchants who now also want to accept payments through the app. Okay, and so this banking in a approach is going to be a platform approach to the merchant acceptance business. Finally, it's one service provider, which is me as the largest acquirer, who's giving him one platform. It's a very simple onboarding process, but he gets all the payment and the banking and the asset services and the value-added services all in one box. Okay, and that is our platform strategy for the growth in the acceptance business. So yes, we've thought about it. We're in the process of ramping that up. Okay, and we've already seen good early results. Very early results, but good results, very good results, because people are appreciating the fact that they now have to deal only with me and not 3 or 4 service providers. Just even for the simple thing, an end of day reconciliation of what payments have I received and what have I made, he gets it on his app in one screen. Okay, that is a significant value, and that's a non-monetary value. So we've seen a lot of the conversation with the merchants also changing once they see the value of that, because they've stopped now talking about saying aapka rate zyada hai, kam hai, but they actually say, boss, wow, it makes my job easier, and that's the value which we want to show, and then that's going to be the backbone of our strategy going forward.
Thank you.
Thank you.
Yeah,
Thanks,
one other thing on this to keep in mind is also about, in addition to these kind of payment factors as such, through the corporate banking and into the commercial banking, which in the prior conversation I alluded to, the supply chain financing, both the distribution chain and the supply chain on that. That is also, though, so not this follow the money financing is not just about only using one of the payment mechanisms, also through the other, for example, the trade financing, invoice discounting, again, no paper, digitally done, but for financing for transaction between one leg of the customer with another leg of our own customer who's on another segment.
Got it. Thank you.
Thanks, Mayuri. Parag, we are running short on time. We've got a few questions on email, so we'll just limit to that. We've got 3 questions. One is on the regulations. So credit on UPI, do you expect some regulations to come out here? Number 1. Number 2, hypothetically, let's say if interchange or MDRs were to be capped or reduced, what impact do you envisage for the industry, hypothetically speaking, or some equation if you can lay out how does that work? So let's take those 2 questions first on regulation, and then I've got one more question.
Okay. So I think credit on UPI is a natural extension of this whole UPI form factor, which is sort of going in. It's an OD line or whatever, which I think many sort of banks, including us, have already sort of introduced. Okay, like I said, the way we're looking at it is, for me, therefore, it really doesn't pose, it only helps expand the marketplace. So if you're anyway using UPI and not using a card, then taking a loan or taking a small loan on a UPI exchange is a natural extension of your transaction. It's my job as a large issuer to provide that facility also to my customers, and we're doing that very clearly. So I think it will only help expanding the marketplace, given the fact that UPI also is focusing by default or by design on smaller ticket transactions. It helps sort of funding into that space. Typically, people use credit cards, etc., for funding larger purchases, higher ticket size purchases. So you've got all flanks covered. So that's something. This is something which we definitely I think encourage and will be an important part of our suite. Coming to your question of regulation, I mentioned my views about MDR, etc., and I think it's a debate which is happening between the regulator and all the banks put together. Having said this, if there seems to be downward pressure, just in case, and hypothetically, it's a downward pressure, I think, especially in the credit card space, I'll give you two perspectives. If I look at it from a credit card point of view, I think more or less what will happen, or what happened in the debit card space, will also happen in the credit card space. So when MDR got capped on debit, what happened is a lot of the functionalities and features, even though they were very less on a debit card, I think got off. So The difference between the MDR and interchange sort of remained the same, even though the absolute level sort of dropped off. I would suspect that something similar would happen on the credit card side. Okay, that maybe some of the privilege. I'm dead sure definitely all these fancy 5, 10, 20, 30% cashback offers will definitely be the first to go out of the window. Okay, and that will probably make the card portfolio definitely more profitable. If I give you the other perspective, when you look at it from our acquiring side, okay, the HDFC Bank acquiring business actually in terms of volume is about what, 2.5 times our issuing business if you just take the pure spends. Okay, and given the dynamics of the acquiring spends, actually acquiring credit cards on a merchant acquiring mixer is actually, you make far less money as compared to acquiring a debit or a sort of UPI. So in a sense, dropping the MDR and dropping the interchange will probably make the acquiring business far more profitable, number one. And because for HDFC Bank, it's 2.5 times, you'll actually see a far more significant swing in profitability towards the positive, if in case that happens, hypothetically. Okay, so it's a balancing factor for us. Because we are a large issuer and acquirer, okay, we see overall benefit. Some items may be a left pocket, right pocket, if you understand what I'm saying.
Yeah. So on an overall basis, issuance plus acquiring.
For people who are monoliners, only issuing or only credit cards or only acquiring, well, the impact on them could be completely different.
Correct.
Last question. We've got a well-balanced strategy in that sense.
Yeah. I appreciate that. The last question is on the competition from the new age companies, right? Or the offerings, let's say Slice, Postpay, Paytm Postpaid, etc. And some of these banks are offering these PPI instruments along with the fintechs in the garb of, let's say, pseudo credit card product, etc. Does this pose any risk to the credit card revenue pool, either by way of, let's say, the revolve balances, attracting a lower interest rate, or any other, impact that you can envisage because of these new players?
To answer your question shortly, in the short term, maybe. Okay, in the long term, no. Like I said, I'll just repeat what I said. I think building a sustainable growth portfolio, a healthy portfolio, takes time, investment in the right amount of things. Like I said, checking the right customer and deep portfolio engagement. Okay, so like I said, and you'll always get someone or the other new player on the block coming in offering something fancy, because you have to do that to break the clutter. And you'll also get a set of customers who will keep on going. Okay, but we've seen this over the years. Okay, good customers continue coming back and sort of. So in the short term, maybe, but I think in the long term, no. To answer the same question in a different way, you mentioned of people using pseudo prepaid to create credit history. So yeah, there are some practices which happen in the marketplace currently happening. I think one of the roles of this fintech department created by RBI, I think, is also to balance off some of these contradicting things which are happening in the marketplace, to bring a semblance of governance, level playing field, if you may call so, ensuring that people whose core competency is X do those jobs and not do something else, etc., etc. I mean, you've seen some of the announcements which sort of people are making, that including some of the changes already made in terms of asking much more capital requirements from serious digital lenders, etc. Some of the views on in the same BNPL space or digital lending space which the regulator has had, because they impact liquidity of the ecosystem. So I think put together, we're not happy. We welcome good business models and fintechs which actually expand the market, because expanding the market, I think, helps everyone. And because we're a large player in the market, any expansion will only help us. Okay, so we welcome great business ideas, and we're open to partnering with many of these people at any point in time. The rest, I think, would be just at most short term.
Yeah. We are at time. I'll just squeeze in one last question. The revolve balances. So what's the lead lag, time that is required from the time when the credit card spends pick up, that sort of getting converted into the revolve balance, and the credit card profitability again start, becoming a lot better.
Srini, you want to take that, or I can take it? I'll leave it to you.
Yeah, I'll take that. See, as you would see that first the spend has to come, First, you get the right kind of a customer, which we started to get those kind of customers. Then you make the customer to spend, which takes, call it anywhere 2 to 3 months from activation call to engagement with them and so on. 2 to 3 months it takes to get them to do something. Once the spend happens, call that to another 1 to 2 quarters, the spend happens, right? So you make them to spend more. And initially you would see if you got the right kind of a customer, pay downs are happening, right? That means they start to pay. Then after from the beginning, after you bring the customers, take it 3 quarters have gone by, 4 quarters have gone by, then that's when this revolving magic starts, right? Again, the revolving magic has to start. Again, go back to the customer continuum that I mentioned about. That customer would first exhaust, right? His kind of a secured needs, would go and exhaust unsecured low-cost needs, and then will come to revolving type of needs, right? That is logical, customer logical thought process. If you see, you will not see a customer jump into a revolving day one. You will not see that customer, because unlikely that we will bring that customer who jumps in on day one into revolve, right? So that's the kind of, so if you think about this journey, it could be 3-4 quarters that the customer gets to. And then the maturity, right? If you look at the card maturity model, it could take 18 months to 24 months for the card to peak at that maturity level. That's the kind of a journey that you can think about what happens in a card portfolio.
So from September quarter onward, we should start seeing impact of the customer journey showing up in the numbers, in the P&L, operating profits, etc.
Yeah, in some manner or the other, we believe that.
Yeah. Sure.
Help.
Okay. Sorry. Thanks. It was pretty useful discussion, Parag and Srini. Didn't realize 1 hour just passed by. So thank you so much once again. I'm sure everybody has benefited from your insights, and wish you good luck and stay safe. Thank you once again.
Thank you, everyone.
Thank you. Yeah. Bye.
Bye.